Imagine standing at the peak of a financial mountain, watching everyone around you cheer as markets hit record highs, while a small group of investors quietly prepares for the fall. This isn't just a scene from history. It's a pattern that has repeated itself time and time again. In 1929, Joseph Kennedy exited the market just months before the crash and made millions shorting stocks. In 2008, Michael Burry and John Paulson saw the housing bubble coming and positioned themselves to collect billions as the system collapsed. And in 2025, the same sequence is quietly unfolding again. What you're about to see is the four-stage strategy these elite investors follow with mechanical precision, stages that turn panic into profit. Stage 1, exit at the peak. Stage 2, buy protection before everyone else sees the danger. Stage 3, short the most vulnerable sectors. Stage 4, buy at maximum fear. In this video, we'll break down each stage, show how it played out in 1929 and 2008, and reveal what the smart money is doing right now so you can understand the pattern before the next crash hits. Financial crashes aren't random. They don't happen by chance, and they're not caused by mysterious forces. Time and time again, history shows us a clear pattern driven by human behavior and the mechanics of the market. When valuations reach extreme levels, people act in predictable ways. Greed pushes prices higher, fear eventually forces them down, and a disciplined few use both to profit. Understanding this pattern is the first step to seeing what the smartest investors are doing right now. The playbook is surprisingly simple once you break it down into 4 stages. Stage 1 is exiting positions at the peak, moving cash out of overvalued assets before the majority even suspects trouble. Stage 2 is buying volatility insurance, tools like put options, credit default swaps, or VIX calls that pay off when the inevitable downturn arrives. Stage 3 takes things further, targeting the most vulnerable sectors and companies, betting specifically on where the collapse will hit hardest. And Stage 4 is the ultimate payoff, buying at maximum fear, snapping up assets at fire sale prices when panic is everywhere, and most investors have lost hope. These stages repeat because human behavior is consistent and market mechanics don't change. Bubbles always burst, leverage always unwinds, and panic always creates opportunities. While ordinary investors often get trapped by emotion, the top players execute this sequence with discipline, patience, and foresight. This framework isn't theory. It's been proven again and again in 1929, 2008, and as we'll show, right now in 2025. Each stage builds on the last, setting up the next, and if you understand how it works, you'll see exactly where the market is in the cycle today. Let's start with Stage 1, the moment when the smartest investors quietly step aside while everyone else keeps buying at the top. Stage 1 is all about knowing when to step aside. History is full of examples. In 1929, Joseph Kennedy, one of the era's most successful stock speculators, began liquidating his positions months before the market crashed. He wasn't guessing. He understood leverage, margin calls, and the domino effect they could trigger. Investors were borrowing up to 90% of stock values, so even a small decline would force massive selling. Kennedy, along with Bernard Baruch, another legendary investor who'd survived previous panics, recognized the signs. By September 1929, both had moved substantial holdings into cash. 7 weeks later, the Dow peaked on September 3rd and the crash began on Black Thursday, October 24th. Those who exited early avoided catastrophic losses. Fast forward to 2025, and the same stage is playing out. Warren Buffett has held a record $325 billion in cash, citing a lack of attractively priced investments. Jeff Bezos sold over $13 billion in Amazon stock, while Mark Zuckerberg has unloaded billions in Meta shares, even at new highs. Corporate insiders across America are selling at levels not seen since 2007. These aren't random trades. They reflect knowledge ordinary investors don't have, like real earnings, pipelines, and risk exposure. The Buffett Indicator, which compares total stock market capitalization to GDP, currently sits at 185%, well above his 120% danger threshold. This isn't just caution, it's a clear signal that overvaluation is extreme, and the smart money is systematically exiting. Exiting is just the beginning. While ordinary investors remain fully invested, the most sophisticated players are preparing for the next stage. The question isn't if the market will fall, it's when. And the next move is all about protecting against that inevitable collapse. Stage 2 is where the smartest investors don't just step aside, they buy protection against the inevitable fall. Think of it as insurance on the market itself. Tools like put options, VIX calls, or credit default swaps allow investors to profit when volatility spikes or when specific assets collapse. It's a strategy that costs money up front, but the payoff can be massive when panic hits. In 1929, Joseph Kennedy didn't just exit his long positions, he began shorting stocks, borrowing shares to sell at peak prices, and aiming to buy them back cheaper as the market fell. The crash made those positions incredibly profitable, rewarding him for taking calculated risk when everyone else was still confident. Fast forward to 2008. Michael Burry and John Paulson paid premiums for years on credit default swaps tied to subprime mortgages. Month after month, as the housing market rose, their funds lost money and angry investors questioned their strategy. Yet they understood the mechanics. Buy insurance while the system looks stable, and when defaults accelerate, the payoff is enormous. Their patience turned into billions when the housing market collapsed. Even as recently as March 2020, Bill Ammon executed a perfect Stage 2 trade. During the early COVID market crash, he spent $27 million on credit default swaps for investment-grade corporate bonds. Within weeks, the market plunged, and those swaps paid out $2.6 billion, a 96-to-1 return. Today, in 2025, Stage 2 is happening again. Put options on major indices, VIX calls, and credit default swaps on commercial real estate and regional banks have surged in volume. The put-call ratio is elevated, indicating that institutions are paying premiums to hedge against the next major downturn. Commercial mortgage-backed swaps have jumped 300 to 500% in price, signaling that sophisticated investors expect significant defaults. Insurance is in place, but the smart money goes further. Stage 3 isn't about hedging. It's about targeting exactly which sectors and companies will collapse first, setting the stage for even larger gains. Stage 3 is the most aggressive stage, where the smart money doesn't just hedge, they actively bet against the sectors and companies most likely to fail. This is, honestly, precision investing at its finest. Rather than shorting the entire market, top investors identify exactly where the collapse will hit hardest, building positions that will pay off massively when panic arrives. In 2008, Michael Burry and John Paulson exemplified Stage 3 perfectly. Burry analyzed loan-level data, finding the riskiest subprime mortgages in states like Florida, California, Arizona, and Nevada. Paulson went further, shorting specific financial institutions heavily exposed to these failing loans, including Lehman Brothers, Bear Stearns, and Washington Mutual. Analysts labeled these trades reckless. The consensus believed these firms were too big to fail. Yet when defaults accelerated, Paulson's shorts turned billions in profit as these banks collapsed or went bankrupt. Fast forward to 2025. The same logic applies, and the vulnerabilities are clear. Commercial real estate in the United States is in crisis, with office buildings sitting 40 to 50% vacant due to permanent shifts in remote work. Mortgages written at historically low rates are maturing, and refinancing at today's 7 to 9% rates is often impossible. Over $2 trillion in commercial mortgages will come due between 2025 and 2026, and many cannot be refinanced, triggering inevitable defaults. Regional banks are the second target. Unlike large banks, some regional lenders have 20 to 40% of their loan books tied to commercial real estate. When defaults hit, these banks will face massive losses, and some will fail. Hedge funds are already building short positions against these vulnerable banks, betting on the collapse before the broader market notices. While the smart money waits for the collapse, the final stage is where fortunes are made. Stage 4 is the ultimate payoff, buying at maximum fear. When panic has bottomed prices and the market offers opportunities that appear once in a generation. Stage 4 is the ultimate payoff, the moment when panic is at its peak, prices are crushed, and the market seems hopeless. This is where fortunes are made, and only those who executed the first 3 stages have the cash and courage to act. Buying at maximum fear means snapping up assets at fire sale prices when everyone else is selling in terror. In 1929, Joseph Kennedy and Bernard Baruch deployed their cash to buy stocks, real estate, and businesses at depressed prices. Properties were purchased from owners being foreclosed, companies were acquired at auction, and stocks traded far below their intrinsic value. Their patience and preparation transformed them into some of the wealthiest figures of their era, while most investors were wiped out. During the 2008 crash, Warren Buffett made legendary moves at the bottom. He invested $5 billion in Goldman Sachs at the height of panic, acquiring preferred shares with a 10% annual dividend plus warrants to buy common stock at favorable prices. He also bought shares in Bank of America and expanded positions in Wells Fargo, American Express, and other fundamentally strong companies, acquiring them at valuations most investors could only dream of. These investments multiplied many times over as markets recovered. In March 2020, Bill Ammon executed one of the most perfect Stage 4 plays. After profiting from credit default swaps as markets fell, he immediately deployed that capital to buy fundamentally solid companies at deeply discounted prices, including Starbucks, Hilton, and Lowe's. Within months, the market rebounded, and his fund realized enormous gains, proof of how Stage 4 combines preparation with opportunistic action. Stage 4 is coming again. When panic drives stocks down 50 to 60% or more, unemployment spikes, and markets feel like they're collapsing, the same disciplined, well-capitalized investors will act. History shows that massive profits are created not by guessing the bottom, but by having the resources, the patience, and the courage to buy when fear is at its absolute peak. The reason the 4-stage crash pattern works isn't magic. It's human psychology combined with predictable market mechanics. Markets are driven by fear, greed, and leverage. When valuations become extreme, ordinary investors get swept up in optimism, buying at unsustainable prices. The smart money recognizes the signals early, acts with discipline, and positions to profit when the tide inevitably turns. Leverage plays a central role. In bubbles, investors borrow to buy more assets, amplifying gains while the market rises, but also magnifying losses when it falls. When a correction begins, margin calls trigger forced selling, accelerating declines. This is how small losses cascade into panic, wiping out those who stayed fully invested. Meanwhile, disciplined investors who exited early or purchased volatility protection are insulated, watching the panic unfold with capital ready to deploy. Bubbles always burst because human behavior is consistent. Confidence turns to fear, speculation collapses, and panic creates opportunity. Those who understand this sequence don't try to predict the exact timing. They focus on preparation, risk management, and capital allocation. They know that when everyone else is selling, they will have both the cash and the courage to buy at prices ordinary investors can't imagine. History repeats because these mechanics are universal. From 1929 to 2008, the same stages produced the same results. Ordinary investors lost fortunes, while the prepared few multiplied their wealth. Stage 1 builds cash, Stage 2 buys protection, Stage 3 identifies vulnerabilities, Stage 4 exploits maximum fear. It's a system rooted in rational observation of market psychology, not luck. For anyone trying to navigate today's markets, understanding these mechanics gives a huge advantage. You don't need insider tips, you need discipline, patience, and the willingness to act when fear peaks. And right now, in 2025, the same forces are in motion, setting the stage for the next massive opportunity. So, 2025 is shaping up eerily similar to 1929 and 2008. Insider selling across corporate America has reached levels not seen since 2007, signaling that executives who see the real financials and pipelines don't believe current valuations are sustainable. Warren Buffett's indicator, which divides total stock market capitalization by GDP, sits at 185%, far above his 120% danger threshold. Historically, anytime it exceeded 120%, markets eventually corrected sharply. Commercial real estate adds another red flag. Office buildings across major cities sit 40 to 50% vacant, a permanent shift fueled by remote and hybrid work. Mortgages written during low-rate periods are now coming due in an environment of 7 to 9% interest rates, creating inevitable defaults. Over $2 trillion in commercial mortgages will need refinancing through 2026, and many cannot meet new debt obligations, triggering cascading failures. Regional banks are particularly exposed. Unlike big banks that hold a small percentage in commercial real estate, regional lenders may have 20 to 40% of their portfolios tied to these struggling properties. As defaults accelerate, capital is eroded, regulatory minimums are breached, and failures will occur in clusters, just as Stage 3 predicts. The smart money is already executing Stages 1 through 3. Buffett and other top investors are holding record amounts of cash. Hedge funds are buying volatility insurance and establishing short positions in commercial mortgage-backed securities and vulnerable regional banks. They are positioning to profit when the inevitable collapse occurs. So, if the crash is coming, how do you prepare? Understanding these signals and the historical four-stage framework gives you the insight to act wisely, protecting your portfolio, holding cash, and being ready to seize opportunities when panic drives prices to historic lows. While you may not have billions to execute all four stages like Buffett or Aman, understanding the framework still gives you an enormous advantage. Stage 4, the moment of maximum fear, is coming, and preparation is key. First, consider increasing liquidity. Holding 20 to 40% of your portfolio in cash or short-term treasury bills may feel conservative, but this capital gives you the ability to act when markets plunge. You don't need to predict the exact bottom. Having cash ready ensures you can take advantage when panic drives prices down 50 to 60% or more. Second, hedging can protect against losses in the meantime. Put options on broad market ETFs like SPY, or simply understanding how instruments like credit default swaps work allow you to mitigate downside risk. These tools act as insurance. You pay a small premium now to protect your portfolio from large losses later. The key is patience. Like the smart money, you buy insurance before others see the risk. Third, prepare a list of quality companies you want to own once Stage 4 arrives. Focus on firms with strong balance sheets, low debt, and products or services people will always need. These are the assets that historically recover and grow the fastest after a crash. Finally, emotional discipline is essential. Markets during Stage 4 feel chaotic, frightening, and irrational. Every instinct tells you to sell, wait, or hide. But honestly, the opportunity is exactly where fear is highest. Recognizing that panic is a signal, not a threat, separates those who can build wealth from those who lose everything. By holding cash, hedging strategically, and planning purchases in advance, you position yourself to act decisively when history repeats. Stage 4 rewards those who are ready, disciplined, and unshaken by the chaos around them. Timing is everything in the four-stage crash pattern. Historically, once Stage 3, shorting vulnerable sectors, is in place, it can take 6 to 18 months before Stage 4 arrives. This window allows the market to unravel, leverage to unwind, and panic to build, creating the ultimate buying opportunity for those prepared. Several predictive signals have consistently flagged past crashes. The yield curve is one of the most reliable. When short-term interest rates exceed long-term rates, recessions almost always follow within 12 to 18 months. The Buffett Indicator, which compares total market capitalization to GDP, shows when valuations are extreme, like today's 185% reading, well above Buffett's danger threshold of 120%. Insider selling is another critical sign. Corporate executives and major investors who see the real numbers are moving out of positions, often quietly, signaling that they don't believe current prices are sustainable. These signals don't tell you the exact day the market will collapse, but they highlight elevated risk and set expectations. Understanding them allows you to position strategically rather than react emotionally. Stage 4 doesn't happen overnight. It builds as leverage unwinds, liquidity dries up, and fear spreads. Patience is as important as preparation. Those who rush in too early or panic too soon risk losses, while those who wait with cash, hedges, and a prepared list of quality assets can act decisively when opportunity peaks. The key takeaway is that timing is not about prediction. It's about recognizing the setup, understanding the sequence, and staying ready. History shows that crashes don't surprise disciplined, prepared investors. They reward them. The four-stage crash pattern repeats because human behavior and market mechanics don't change. Stage 1 is exiting positions at the peak. Stage 2 is buying volatility insurance to protect against the inevitable downturn. Stage 3 is aggressively shorting the most vulnerable sectors and companies. And Stage 4, the ultimate stage, is buying at maximum fear, deploying capital when panic drives prices to historic lows. Stage 4 is where fortunes are truly made. History shows that those who have executed the first 3 stages successfully and hold cash, hedges, and a prepared list of quality assets can multiply their wealth dramatically, while the majority of retail investors lose everything. 1929, 2008, and 2020 all demonstrate this pattern. The smart money profits on the way down, then seizes assets at the bottom to grow their capital exponentially as markets recover. The question for you is simple, yet profound. Will you recognize the pattern and act when the moment arrives? Or will you hold on blindly, hoping the market keeps rising, only to be wiped out when panic hits? Understanding the signals and the sequence gives you an edge, but acting decisively requires preparation, discipline, and courage. Imagine a scenario where the market drops 50 to 60%. Regional banks fail in clusters, unemployment spikes, and panic spreads through corporate America. If this occurs, history suggests that the first investors ready with capital and strategy will create generational wealth, while unprepared individuals face severe losses. This what-if scenario isn't a prediction, it's a framework to understand opportunity and risk. Being ready doesn't mean forecasting the exact day, it means seeing the setup, preparing your resources, and staying disciplined. Stage 4 will come. The only question is whether you'll be among the few who profit or the many who regret missing it.